The history of modern finance, when viewed through a wide enough lens, reveals itself not as a chaotic series of random events, but as a rhythmic, almost respiratory cycle of expansion and contraction, hubris and humiliation. Every major financial cataclysm of the last century, from the Great Crash of 1929 to Black Monday in 1987, the dot-com implosion of 2000, and the Great Financial Crisis of 2008, has adhered to a rigid, deterministic structural pattern. This is not a matter of similar rhyming verses. It is the exact same verse repeated with different actors. It is a five-stage sequence that manifests months, and occasionally years, before the final collapse occurs, serving as a silent siren that screams to those few who know how to listen. The institutions of Wall Street, the governors of the Federal Reserve, and the stewards of dynastic wealth are intimately familiar with this sequence. They rely on it. However, the general public remains perpetually oblivious, largely because the financial industry thrives on the asymmetry of information. If the average investor understood the anatomy of a crash, the liquidity required for the smart money to exit would vanish. Today, an objective analysis of macroeconomic data, market structure, and institutional behavior suggests that the global financial system is not merely approaching a correction, but is deep within the progression of a historic reset. To understand where we stand, we must look back to the archetype of all modern crashes. In the late summer of 1929, a man named Roger Babson stood before a business conference and delivered a speech that would make him a pariah. While the Roaring Twenties were at their zenith, fueled by jazz, bootleg liquor, and easy money, Babson uttered 9 words that cut through the euphoria. Sooner or later, a crash is coming, and it may be terrific. The reaction was immediate and visceral. The audience laughed. Newspapers mocked him as a doom-monger, and Irving Fisher, the most celebrated economist of the era, publicly dismissed him. Fisher famously declared that stock prices had reached a permanently high plateau, a sentiment that captures the delusion of the age. 47 days later, the market disintegrated. Fisher lost his fortune, his reputation, and died in poverty. Babson, however, had not been guessing. He had developed a systematic method for analyzing financial conditions based on credit levels, market concentration, and liquidity flows. He had identified a specific sequence of deterioration that inevitably leads to collapse. We have spent months cross-referencing Babson's framework with the Federal Reserve data and historical records across every major recession of the last 100 years, and the conclusion is chilling. The pattern holds in every single instance. Today, the indicators suggest we are further along in this sequence than almost anyone is willing to admit. The sequence invariably begins with stage 1, the credit explosion. This is the foundation of the bubble, the period where the seeds of destruction are sown. A crash never begins with greed alone. It begins with the availability of cheap debt that expands faster than the real economy's ability to absorb it. This excess credit does not flow into productive capacity, factories, research, or infrastructure, but leaks into asset markets. Investors borrow money they cannot afford to repay to purchase assets at prices that make no fundamental sense. As buying pressure pushes prices upward, the value of the collateral increases, allowing for even more borrowing. It is a positive feedback loop that mimics prosperity, but is, in reality, a leverage trap. In the late 1920s, this manifested as margin debt, where ordinary Americans, from elevator operators to factory foremen, were putting down 10% cash and borrowing 90% to buy stocks. By 1929, total margin debt was roughly equivalent to the entire federal budget. In 2007, the vehicle was mortgage debt, packaged into exotic securities that allowed reckless leverage to permeate the global banking system. Looking at the present day, the credit situation is not merely echoing the past, it has surpassed it. While official margin debt sits at a seemingly manageable level, this figure is a dangerous illusion that fails to capture the modern shadow banking system. When one accounts for securities-based lending, where the ultra-wealthy borrow against their portfolios to avoid capital gains taxes, and the trillions of dollars in notional exposure embedded in the derivatives and options markets, the true leverage in the system is staggering. Furthermore, corporate debt has exploded to over $10 trillion, a significant portion of which was not used for innovation, but for stock buybacks, artificially inflating earnings per share while weakening corporate balance sheets. Superimposed on this is the sovereign debt crisis, with U.S. government debt crossing $34 trillion, necessitating interest payments that now exceed the defense budget. As a percentage of GDP, total debt in the American economy is higher today than it was in 1929 or 2008. Stage 1 is not just active, it has metastasized. As the credit cycle matures and asset prices inflate, the market enters stage 2, the concentration trap. This is perhaps the most misunderstood aspect of market mechanics. Crashes are rarely caused simply because valuations are high. They occur because the market structure becomes fragile due to a lack of breadth. In a healthy bull market, the majority of stocks participate in the rally. In a dying market, the rally narrows to a handful of glamour stocks that mask the rot underneath. When a small number of assets carry a disproportionate share of the market's total value, the entire system becomes susceptible to a single point of failure. In 1929, the market was dominated by Radio Corporation of America, RCA, and a few utility trusts. RCA shares skyrocketed from under $2 to over $500, driven by a narrative of technological revolution that blinded investors to financial reality. When RCA cracked, it dragged the entire index down with it. Similarly, the dot-com bubble of 2000 was essentially a wager on a dozen massive technology companies. When the Nasdaq collapsed, trillions of dollars in wealth evaporated, even though the old economy stocks had barely moved. Today, we are witnessing the most extreme market concentration in history. The indices are dominated by the so-called Magnificent Seven: Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. At various points recently, these 7 companies have accounted for over 30% of the S&P 500's total value. This creates a terrifying distortion for the average investor. When one purchases a passive index fund, they are not diversifying. They are making a leveraged bet on 7 companies. The rise of passive investing has exacerbated this dynamic. Every dollar that flows into an ETF automatically buys more of the larger stocks, pushing their prices higher and increasing their weight in the index, which in turn demands that the next dollar buy even more of them. It is a momentum machine that works beautifully on the way up, but will act as a devastating accelerant on the way down. If these 7 stocks were to correct by 50%, a standard mean reversion for overvalued tech assets, the broad indices would plummet regardless of the performance of the remaining 493 companies. The market has effectively been hollowed out, leaving a thin veneer of stability supported by a handful of pillars. Stage 2 is undeniably confirmed. While the retail public chases these concentrated winners, entranced by the narrative of artificial intelligence and perpetual growth, The cycle moves quietly into stage 3, the smart money exit. This stage represents the great divergence between the sophisticated insiders and the unsophisticated outsiders. Before every major collapse, there is a distinct period where institutional investors, banks, hedge funds, family offices, and corporate executives begin to reduce their exposure. They do not ring a bell. They do not issue press releases warning of impending doom. On the contrary, their public statements often encourage retail investors to stay the course or buy the dip, providing the very exit liquidity the institutions need to offload their massive positions without crashing the price. In 1929, the Morgan and Rockefeller families began liquidating their portfolios in the early summer, months before the October crash. Joseph Kennedy famously sold his entire portfolio after a shoeshine boy gave him stock tips, realizing that when the lowest levels of society are speculating, the top has been reached. In 2007, Goldman Sachs was aggressively selling mortgage-backed securities to its clients, while simultaneously betting against those same securities on its own proprietary trading desk. The data from the current cycle indicates that the distribution phase is well underway. Corporate insider selling has reached levels not seen in decades. CEOs and board members, the individuals with the most intimate knowledge of their company's true prospects, are dumping stock at a historic pace. The ratio of insider selling to insider buying is at extreme levels. For every executive buying shares, there are multitudes selling. Simultaneously, retail investors have been pouring money into the market at record rates, driven by FOMO, fear of missing out, and the gamification of trading. We are witnessing a massive transfer of risk from the strong hands of the smart money to the weak hands of the general public. The smart money is holding cash and hedging. The public is holding the bag. This divergence is the hallmark of a market peak. It is the transfer of wealth before the destruction of wealth. As the distribution phase concludes, the market enters the most deceptive and dangerous period of the sequence, stage 4, the liquidity illusion. At this stage, prices may still be high, volatility may seem low, and the headlines may declare that a soft landing has been achieved. However, beneath the surface, the liquidity that acts as the oxygen for the financial system is being aggressively drained. Liquidity is what allows buyers and sellers to transact without moving prices violently. When liquidity is abundant, markets are resilient. When it evaporates, markets become brittle. In 1998 and early 1929, the Federal Reserve raised interest rates to cool speculation, inadvertently draining the system of the cash needed to support leveraged positions. For a time, the market ignored this tightening, leading investors to believe that the Fed doesn't matter. But when the selling finally started, the bids simply vanished. The floor fell out because there was no money left on the sidelines to step in. A similar dynamic played out in 2008. The Fed had been hiking rates for years, yet the market stayed aloft until the moment it didn't. Currently, we are living through the most aggressive monetary tightening campaign in 40 years. The Federal Reserve has raised interest rates from near zero to over 5% in less than 2 years and is simultaneously engaging in quantitative tightening, pulling hundreds of billions of dollars out of the financial system. Yet, because the stock market remains near all-time highs, the consensus view is that the economy has absorbed these hikes without damage. This is the illusion. The cracks are already visible to those who look. In March of 2023, 3 major U.S. banks, Silicon Valley Bank, Signature Bank, and First Republic, failed in the span of a single week. These were not small, irrelevant institutions. They were victims of a liquidity crisis caused by the devaluation of bond portfolios. The Fed responded with emergency lending programs, essentially placing a temporary patch over a gaping wound. Furthermore, the U.S. Treasury market, the bedrock of the entire global financial system, has experienced episodes of extreme illiquidity. When the risk-free asset becomes difficult to trade, it is a signal that the plumbing of the financial system is clogged. We are currently walking on a tightrope over a vacuum. The liquidity that supported the asset inflation of the last decade is gone, replaced by the high cost of capital. Stage 4 is the silence before the thunder. This brings us to the final, inevitable conclusion of the sequence. Stage 5, the trigger. This is the only stage that resists precise prediction, and that unpredictability is what makes it so devastating. The trigger is the event that transforms a vulnerable, illiquid, highly concentrated and over-leveraged market into a collapsing one. It is crucial to understand that the trigger is not the cause of the crash. The cause is the accumulation of debt, the concentration of risk, the exit of smart money, and the drainage of liquidity, stages 1 through 4. The trigger is merely the match thrown into the warehouse of dynamite. In 1929, the trigger was the Clarence Hatry fraud case in London, a seemingly minor event that forced British banks to liquidate American assets, starting a cascade of selling. In 2008, it was the bankruptcy of Lehman Brothers, though it could easily have been any number of other insolvent institutions. The system was primed to explode. Lehman was just the spark. Speculating on the specific nature of the next trigger is an exercise in probability, not certainty, but the potential catalysts are numerous. It could be geopolitical, a sudden escalation in the Taiwan Strait, a miscalculation in the Middle East that severs energy supply lines, or a conflict involving NATO and Russia. It could be financial, the implosion of a major multi-strategy hedge fund, a sovereign debt crisis in a G7 nation, or derivatives accident, where counterparty failure ripples through the $600 trillion derivatives market. It could be the slow-motion car crash of commercial real estate, where trillions in loans are coming due at interest rates that borrowers cannot afford, threatening to take down hundreds of regional banks. Or, as is often the case, it could be an unknown, something entirely outside the current discourse. The specific nature of the trigger is irrelevant. What matters is the fragility of the system it impacts. Based on historical lag times, once the first 4 stages are fully established, the trigger usually arrives within 12 to 24 months. With the liquidity drain biting hard and the yield curve signaling recession, the window of maximum danger lies directly ahead, likely spanning the next 2 years. The realization that we are following a script written in the ruins of 1929 and 2008 leads to a stark conclusion. The narrative of "this time is different" is the most expensive sentence in the English language. It is a psychological defense mechanism used to justify inaction in the face of overwhelming evidence. Roger Babson did not possess a crystal ball. He possessed the discipline to trust the data over the crowd. While his contemporaries mocked him, he systematically moved his wealth into cash and tangible assets. He bought farmland, he paid off debts, he prepared for winter in the middle of summer. When the crash came, Babson was not only insulated from the carnage, but was positioned to acquire high-quality assets for pennies on the dollar. Irving Fisher, who relied on his intellect and the consensus of his peers, lost everything. The difference was not intelligence. It was the willingness to accept an uncomfortable reality. For the individual investor today, the implications of this analysis are profound and urgent. The market has conditioned an entire generation to believe that stocks only go up and that the central bank will always save the day. This conditioning is the final trap. If the market were to decline by 50%, a move that would merely return valuations to their historical averages, it would devastate the retirement plans of millions. The Welsh effect would reverse, crushing consumer spending and plunging the economy into a deep recession. This is not a theoretical exercise. It is the historical mean reversion of a credit cycle that has run too hot for too long. The signals are flashing red. Leverage is hidden but massive. Market breadth is non-existent. Insiders are selling and liquidity is drying up. The pattern is complete. The choice facing investors now is the same choice that faced the public in 1929. One can choose to ignore the structural faults, trust the reassurances of televised experts, and hope that the permanently high plateau is real. Or one can look at the pattern, acknowledge the fragility of the moment, and take steps to protect oneself. This does not mean panic, it means preparation. It means assessing one's exposure to the concentrated bubbles, questioning the liquidity of one's assets, and understanding that the return of capital is currently more important than the return on capital. The crash of 1929 destroyed lives, not because it was unforeseeable, but because it was unforeseen by those who refused to look. The 5 stages have played out. The stage is set. The warning has been delivered. What happens next is no longer a matter of prediction, but of preparation.